Well, howdy, folks, and welcome to the Daily Coin. And my name is Rory, and I have on the line a gentleman that I was introduced to his work by way of SGT Report. And through Sean and SGT Report, I've been following John's work for a number of years. He is a co-author of the best-selling book, The Money Bubble. He's a market analyst and publisher of the very popular DollarCollapse.com. Mr. John Rubino, how are you today, John?
I'm great, Rory. Good to talk to you finally.
Same here. We've been trying to connect for a while. I was trying to set you up with Sean, and something fell apart there, but we'll get you rescheduled over there as well. And hopefully within the next couple of weeks, we'll have you over on SGT Report.
Okay.
And the understanding that I have is that the credit default swaps are one of the biggest, if not the biggest, financial dangers on the planet. And with credit default swaps being triggered, how is that going to impact the daisy chain of liabilities in the OTC market? And are we going to see other banks or investment firms seize up due to their exposure in the OTC market?
Well, credit default swaps are a really interesting story that require a little bit of background to make sense out of what's happening with them today. And basically, what they are is a contract between two private parties, usually two financial institutions, where one of them agrees to guarantee the payments on a bond issue. In other words, if General Motors, for instance, has a bond outstanding, you can buy insurance that will cover you in case GM defaults on its bonds. And that's what the credit default swap is. It's basically a piece of insurance. But because it's unregulated, this market, the guys running these markets basically got themselves exempted from regulation by the US government a while back. And so they can do anything they want to. They can write insurance for vastly more than the amount of bonds outstanding. So let's say there's $1 million of General Motors bonds outstanding. Well, these big banks and these hedge funds can write insurance for $100 million on those bonds. So it has become just basically a casino where these guys gamble without actually relating what they're buying and selling back to the original instrument that these things were supposed to be a derivative of. Okay, so now you've got hundreds of trillions of dollars of credit default swaps out there right now, which vastly exceed the amount of bonds that are out to write insurance on. So trouble in any one bond issue can have a really disproportionate impact on the market because, if the bond issue is $10 million, it could cause $100 million of liabilities for the people who have written insurance on them out there. And we don't know. Nobody's telling us who owns what and what their exposure is, because what the big banks do and the hedge funds is they net out their long and short positions and they come up with a net exposure that is really small. So it looks like they don't have a lot of exposure, but it's only small because they're counting on the other guys, the people on the other sides of these contracts to make good. And if they can't, then all of a sudden this minuscule exposure becomes this huge liability. So now we are at the point where with this Austrian bank, it's been allowed to go bust, basically, which is new. Prior to this episode, most banks, when they get in trouble, the government just bails them out with taxpayer money and makes good on all the bonds and all the equities and everything. So these guys, the rich people who have invested and who've gambled on these institutions, come away scot-free. And taxpayers are on the hook for whatever bad decisions they might have made. Well, now they're doing it differently because they can't sell taxpayer bailouts to the electorate anymore in most of the world. And so they're doing something called a bail-in, where now if a bank gets into trouble, its bondholders and its equity holders, the people who have invested in the bank, have to take big haircuts. They have to lose money. And when a bond issue defaults, that activates those credit default swaps, that insurance that we talked about before. And so all we know right now is that there's a lot of it out there and that it has to pay off. We don't know who owns it, and we don't know how much any one institution is on the hook for this bank having to default on its bonds. But we know the numbers are really big. So we can't say for sure what the impact is going to be, but it's conceivable that it's dramatic, that some hedge funds or maybe even a big bank are impaired by this, and maybe somebody goes bankrupt, and maybe that reverberates through the system. That happened with Lehman Brothers in the U.S. in 2008, where the government was just bailing out everybody in sight. They finally decided to let a big Wall Street firm go bankrupt, and that almost took down the whole global financial system because one set of credit default swaps were activated, but the guys who were supposed to make good on that insurance couldn't do it, and then they went bankrupt, and their paper impacted other people, and it just reverberated through the global financial system. So someday, something like that is coming again, where somebody blows up, which is the first domino that takes down many other dominoes and which threatens the whole system. And we can't know if this is it. The way the financial system is behaving right now, it's not. Nobody seems that worried. And of course they in previous crises weren't worried until they had to be worried.
Right.
And so we don't know. But this is the kind of thing that could conceivably cause a much bigger problem. And if it doesn't, something else is going to come along in the not too distant future to cause a big problem because, we've borrowed way too much money. We've taken on way too many financial obligations with these derivatives that we talked about and with government debt. And now in the U.S., the new hot kind of loan is subprime auto loans, which that's going to end well,
Yeah.
And so student loans, we're seeing defaults spike in student loans because we lent too many kids too much money for educations that really don't result in high incomes anymore, and so all kinds of things could blow up. We've created the situation in which we've got problems brewing in a lot of places. And governments don't know what to do about it because there really is no solution to too much debt or no pain-free solution. There's just different kinds of crises that are possible once you've borrowed more than you can ever hope to pay off. And that's what we're looking at now, and that's what governments are grappling with. They really don't know what to do about all this. And so what they're doing is lowering interest rates, because that's really the only tool that they've got that seems to have worked in the past. That's the only thing they understand. And so now you've got around the world about $2 trillion of bonds trading with negative interest rates. In other words, if you want to buy a bond of Nestle, the big Swiss chocolate company, which means you want to lend them money. Well, they don't pay you interest on that loan. You have to pay them for the privilege of lending them money. And that's how crazy things have gotten out there. So total debt actually went up, but it just became government debt rather than private sector debt. And so we're back to where some kind of a crisis is highly likely because we're so leveraged. But you can't know ahead of time what is going to set off the crisis. And over the last 3 or 4 years, there have been a whole series of crises. Greece has blown up 2 or 3 times already.
Yep.
And Europe has had several other things that where interest rates spiked in Italy or Spain, and that could have done it right there. But they managed, by creating more currency and borrowing more money, to get past those mini crises and stop them from metastasizing into something much bigger. And so with this Austrian bank, looks like that in a lot of ways. It looks like the other crises that they were able to get past. So there's no reason to think that we can't get past this. But at the same time, we know something big is going to happen, and it's going to be another Lehman moment. It's going to be something that becomes much bigger than it itself begins as. And so this might be it, this might not be it. There's no way to know until after the fact. So all you can do as an individual is just get out of the way, and not be exposed to this stuff. And if you're debt-free and you own some precious metals, which will tend to do well over time in these kinds of crises, because that's where people go when they're scared. And otherwise, your finances are very simple and clean and not exposed to the sectors of the economy that are going to blow up, like the big banks and government debt and stuff like that. You don't really want to lend a lot of money to governments and banks right now. So if you do those things, then there's a chance that you can sail through this without really catastrophic damage to your families and your own finances. But that's really all we're left with. There's no way to make political changes that fix this. There's no way to influence what's going on in the global economy because it has a momentum of its own. Everybody knows, all the big governments know that they have to inflate or die. In other words, they have to continue to increase the amount of currency that they're creating and borrow more money and encourage their citizens to borrow more money, or the system grinds to a halt, or worse. And so in that sense, it's on autopilot. It doesn't matter who our president is. It doesn't matter which party controls Congress. The government is still going to spend more and more money each year. It's still going to borrow more and more money or encourage the private sector to borrow more and more money. And it's still going to run the printing presses flat out. That's all baked in the cake. It can't be stopped by any one politician or any one political party. So that's where we are now. We're on this, in these action movies where somebody's on a boat and they look up and they realize there's a waterfall out ahead and there's nothing they can do about it. That's kind of what the global financial system is like right now. And so we as individuals can only protect ourselves. We can't fix the system. It has to run its course, collapse, and then we can have an interesting argument about what to rebuild from the rubble. But right now, the institutional momentum of the world is such that we're heading off that waterfall. And the only question is how fast we go from here.
Now, do you see how will Greece fit into everything that you just said? Because they seem to be the wild card as far as Varoufakis. He's now arguing with, or Schäuble is making these comments that seem to be out of balance with everything that's going on. Or am I misreading that? I mean, it seems like that's something not very positive for the euro and the European Union is going to come out of that. And I've actually been saying, John, that I personally believe that Greece is going to leave the euro and they are going to reintroduce the drachma. And just say that does in fact happen. What kind of impact would that have on the situation in Europe with Portugal, with Spain, with Italy, with all of their debt and everything that's going on? Or would it have anything to do with it?
Well, see, that's the key point here. Greece is a tiny little country. It's a tiny fraction of the Eurozone economy. So just looking at the numbers, you'd think they could just say, all right, look, this didn't quite work out. Why don't we just have you leave the Eurozone, go back to the drachma, and live life as you see fit? Well, two reasons. One is that over the last few years, Greece has borrowed a lot of money in euros. And so a lot of people hold that debt. A lot of European governments, the European Central Bank, they have that Greek debt. So if Greece goes back to the drachma and defaults one way or another on that debt, somebody has to take a big loss. And even so, the numbers aren't big enough that it would crater the Eurozone, but it would set a precedent. And as you said, the other countries are what matters. Italy and Spain have problems almost as severe as Greece's. They have almost as much trouble living within the common currency of the Eurozone, because in the past they could run up big deficits and then devalue their currencies and sort of kind of get by in that way. But you can't, if you're Italy, you can't devalue the euro all by yourself. So you're kind of stuck living within a relatively strong currency regime. And so their debts are soaring. Italy's public debt as a percent of GDP is just rocketing now. It's approaching Greece's, which is in turn approaching Japan's. Those are the three countries with the insane amounts of government debt. And so if Greece leaves, then the big fear is that isn't the end of the process, but the beginning of a process in which Italy lines up for some kind of help, and then Portugal, and then Spain, and then Ireland, and the rest of the Eurozone, and even France. Their numbers are pretty horrible too, and they've got political parties in all of these countries that are rising in popularity. Who would do this? If they win the election, they would either demand concessions from the rest of the Eurozone or take their country out of the Eurozone altogether. And at that point, you get chaos because there's all this euro-denominated debt that was borrowed by Italy and Spain and Portugal and the others that is on the books of the big banks, and let that debt be devalued in some way. Let it be worth only, say, half of what it is carried on their books at. And then their finances are thrown into disarray. They aren't solvent anymore. And so you have a banking collapse across the Eurozone, and that's the big danger, you know? And it's completely possible that it could go that way because these countries can't figure out how to survive in the same currency regime that Germany likes. And so, yeah, you know, we'll see it resolve one way or the other in the next few years, but it either resolves by these countries leaving or by Germany basically just taking over the Eurozone and dictating to the rest of the peripheral countries, who then become much poorer by trying to live under Germany-style rules, or they all stay together and they devalue the euro together dramatically. Mm. And that's probably the most likely scenario right now, where they just say, okay, you know, the euro used to be worth $1.30. Now it's going to be worth 60 cents. And so, and that's the devaluation that these peripheral countries need. Germany just eats it. They don't want to do this, but they actually kind of benefit from it because they're an export powerhouse. So their stuff gets cheaper than US exports, and they gain a big competitive advantage. But of course, that hurts us. And we will respond in kind. You know, we'll devalue the dollar if that's what happens. And so then the currency war, that you hear this term everywhere, and that's basically what it is countries trying to survive by lowering the value of their currencies, but hurting their trading partners, who then respond in kind, and you get this race to the bottom in currency values. And that's what a massive euro devaluation in order to keep the Eurozone together would cause. So we would have this nightmare global scenario in which everybody's trying to disadvantage their neighbors by cutting the value of their currency, and then nobody being able to count on anything, because who knows what your savings are worth when your currency is being actively devalued? Who knows how to invest in the stock market or the bond market at times like that? You know, it becomes really uncertain, and capitalism hates uncertainty.
Yes.
You know, if you're going to build a factory that's going to exist for 30 years, you kind of want to know what the world's going to be like in year 20, right?
Yes.
And if you can't know that, you don't build the factory. So the animal spirits of capitalists just kind of shrivel up and die for a while in this kind of a scenario. And so you get a global economy that just grinds to a halt. And, you know, that's one scenario. There are others that are much more catastrophic in the short run, but none of them are pretty, you know? None of them are fun to live through. And so we basically have our choice of several horrible decades. And no choice of a good decade. There's no way to get out of this painlessly.
Well, there may be, and what you said is that if they devalue the euro by somewhere around half, then that would in fact help. That would benefit most everybody in the eurozone that's currently using the euro. What if they went ahead and did a debt jubilee? How would that? I know that that's not really in the banker's best interest, and they're not going to do that. But I mean, how would that impact everything?
Well, see, a global debt jubilee is one of those wild cards that we've never seen before. I mean, we've never tried it in the modern world, so we don't know for sure how it's going to play out. But there's no way to do it without there being winners and losers.
Right.
And so then you get, you know, what happens to the losers? For instance, if you do the biblical version of a debt jubilee is saying, well, your debts are all wiped out. But of course, a debt is an asset of somebody else. You know, yes. The banks expect to get paid back. And if the government says, well, all the mortgages from now on are zeroed out. Well, the banks that hold these mortgages and had lent money and expected to be paid back and make money on the process now are stuck with this massive loss. And so they go bankrupt. So then you have to bail out the banks in some way by saying that, we'll print a lot of money and give it to you. And in the process, you know, remember, the global economy is incredibly complex and incredibly big. And for bureaucrats to make decisions with tens of trillions of dollars and throwing them at all these different segments of the economy and trying to make it balance out is really impossible. The global economy is vastly more complex than the human brain. And so they'll screw it up. There might be some perfect way of navigating a global debt for currency swap, where the government just buys in all the debts and gives people back currency and somehow gets out from under all this. But there's no way to do it in practice. That's a theoretical possibility that has a 0.0001 chance of working, just because it's too complicated for the people involved. And having said that, though, I will say that we're trying that on a piecemeal basis. Like when President Obama comes out and says, well, we're going to make your student loans less onerous by allowing you to only pay back this little bit if you work in this segment of the economy or something like that. That's kind of a debt jubilee for student lenders or student borrowers, right?
Yes.
And when they offered cash for clunkers, or all these different TARP kinds of things where they helped you out with your mortgage if you met certain criteria, that's also kind of a debt jubilee on a targeted basis. So QE? We are trying. Yeah, QE. QE is sort of, well, see, QE is a debt jubilee for the banks.
Exactly.
And so what a lot of people are proposing now is a debt jubilee or QE for individuals, where they take your mortgage and they just, they give you cash equal to half your mortgage with a stipulation that you use it to pay off your debts, whatever, something like that. And
is that really on the table?
No, but there are people.
Okay.
There's an economist named Steve Keen who is proposing it and getting some press, and that's certainly something that, for instance, Paul Krugman or your average liberal economist would love to see happen. So to the extent that we get really desperate, and the guys who are saying, well, our problem is that we're not borrowing enough money and we're not creating enough new currency, if they are elected, or people who they back are elected and then put them in charge of the treasury or whatever, we could see it happen. It would be the next experiment that we try in an era of extreme experimentation. But my guess is that it would just fail miserably. Because, at that point, we're sort of doing straight out debt monetization, like Weimar Germany did, where you just print currency, buy back all the debt, and you flood the system with newly created currency. And that's the kind of thing that has so many unintended consequences that then require you to do something even more extreme until you're just randomly doing stuff. That's where we would get to. We would have the government just pulling ideas out of thin air and announcing them, and then having to backtrack 2 weeks later and try something even more extreme, which, on a monthly basis, we're kind of doing that now. We've had 5 different liquefaction programs. We've been through so many QEs already, and it's not working. Most of the world is actually shrinking now. The global economy, the economic growth rate of the entire global economy has been declining for the last 2 or 3 years, and it's rapidly heading for zero after all this money that we created and printed. We've kind of done a debt jubilee in many ways, and it didn't work. So
it's because the bankers were in charge of it.
Yeah. Well, and see, that's the argument that will be used next time around when people say, well, look, we helped the bankers, but they didn't help us. So now let's just help ourselves directly. Let's just vote for free money from the Federal Reserve. And that is kind of the last stage of the process, but it's very hard to see how it, quote unquote, works, how it gets us back to a stable, growing economy that doesn't require huge amounts of new leverage every year in order to not implode. But I do think we'll try it. So, and you never know. It could conceivably work if done perfectly. I just don't have faith in these guys to be able to understand what they're doing.
No, I have zero faith in their policies and in what they're doing. They've proven themselves to be incompetent and incapable of doing anything that's along the lines of being correct. So, but I have one last question that I want to ask you, John, and it ties into with everything that we've just been talking about, but it's on the other side of the U.S. debt, and that's our creditors. And let's say that we get helicopter Ben, dropping $1,000 a month into everybody's mailbox. How is China and Japan and Russia and our other creditors? And speaking of Russia, they have now released the SWIFT system, the alternative SWIFT system, and so there's two. So if we did do the helicopter drop, that I would think would infuriate our creditors, and the SWIFT system, I would think that that's going to have a massive impact on our economy, on the U.S. economy in particular, on the dollar. And how would that even work? How does that work as far as these two factors coming in to the situation where we currently stand?
Yeah. Well, there are a lot of other countries in the world who don't like us for various reasons. And one of the big reasons is that we have this huge economic privilege in the sense that we own the world's reserve currency. Everybody wants dollars. So that allows us to basically just borrow unlimited amounts of money from the rest of the world because they want as many dollars as we're willing to give them. And that allows us to build up and run a global military empire that just drives Russia and China crazy because we can push them around and we just dictate terms all around the world. And if somebody crosses us, we just invade them, and they don't like that. They see themselves as superpowers in their own right, at least in their own neighborhoods. And they would like to have control over Eurasia and Asia, respectively. And the fact that because we have the dollar, are able to push them around is something that's less and less tolerable for them. So what they're doing is they're cutting deals among themselves to use their own currencies for trading and just bypass the dollar. So Russia and China right now are trading natural gas, for instance, from Russia to China, and using their own currencies. And they, as you said, they're setting up payment systems for their banks that bypass the system that the U.S. runs. And they're setting up a development bank that bypasses the IMF, which the U.S. runs. And the ultimate goal is to set up a system that operates outside of dollar hegemony, and which will then presumably give them a little bit of leeway to run their own neighborhoods as they see fit, and will weaken the ability of the U.S. to just borrow insane amounts of money and use it to push around the rest of the world. So right now, see, this takes a long time to come to fruition. And so this is a years and maybe decade-long process before it actually has a really, really definitive impact. But it's a start. And to the extent that, for instance, the Chinese yuan becomes a global trading currency, and it's starting to, it's gone from 1 or 2% of global trade to several percent now, I think. And I think it's heading for 10% in the not too distant future. That's a very big deal because, right now the dollar's been the only game in town for a long time. And if that begins to change, or if it's even perceived to be changing, even if it doesn't change much in the short run, that's a big deal for the U.S. It makes us a lot less able to just pull out that unlimited credit card and use it to do anything we want around the world. And you know what? Not a moment too soon, because we are no longer a force for good. We've been corrupted by this easy money, which has led us to just push people around in ways that we shouldn't be able to, morally as well as geopolitically. And, the Middle East is a perfect example of this. We've been invading these guys over and over again since really the 1950s from the U.S. standpoint. And it hasn't done us a bit of good, has it? Our interests are more at risk today than they've ever been in the Middle East. And here we are thinking about invading again. We're putting boots on the ground to fight ISIS, and we're thinking about moving into Syria. And Iraq is starting to spin out of control. And what are we going to do there? And we're picking a fight with Iran as we speak right now. The whole nuclear program negotiations are ongoing, and we're making a lot of threats with regard to them. So it's only going to get worse because we're making a bigger and bigger mess of things over there. If we had taken the money that we spent just invading Iraq over the last 20 years and put it towards energy independence here, we wouldn't need Middle Eastern oil, and we could just let those guys sort out their own futures. Let the Islamic world have its reformation and decide what the role of religion in government is going to be, and then reconnect with them after they've figured it out in their more or less stable society. We could have done all that, but we haven't, and so we feel like we need to stay in the Middle East and continue to try to fix things, even though what we're really doing is just dealing with the consequences of our past mistakes by making even bigger mistakes. So, and this has no kind of political resonance in the U.S. Ron Paul, who's the only major political candidate who talks like this, gets 5% of the vote in national elections, and that's it. So we're going to keep doing this because there's no political will for doing anything else. Just like there's no political will for raising interest rates and trying to scale back our borrowing. All of this stuff, and it all comes back to the printing press. When the U.S. went off the gold standard in 1971, we gave ourselves an unlimited printing press because the currency wasn't backed by anything, and we could just make as much as we want. Well, that has totally corrupted society at every level because now we don't think we have to prioritize, and nobody wants to hear about it. Nobody wants to hear about, we need to scale back our military adventurism, or we need to borrow less money because that hurts in the short run. And we don't feel like we have to accept pain in the short run because we haven't had to for 30 or 40 years. We've been able just to borrow and spend our way out of every problem.
Well, but that's kind of my point. I mean, that's I don't understand why a creditor would continue to lend us money. I don't understand why China or Russia or India or any of the other countries that are currently our creditors, why they would continue to be our creditors.
Well, because they have money that they have to put somewhere. And right now their choices are pretty slim because as far as government bonds go, you're still, to this day, more likely to be paid back if you own treasuries than anything else.
Why not put it in gold, though?
Well, they're doing that. I mean, they're using their dollars to buy huge amounts of gold in Russia and India and China. So they're kind of operating on a two-track program right now where they still owned a lot of dollars because there's nowhere else to put those dollars in the short run, but they're buying a lot of gold with some of their dollars each year. And I think their goal at some point in the future is to have enough gold and to have currencies that function for trade well enough that they just don't need dollars anymore. But see, they can't dump their dollars all at once because that would make what they own so much less valuable that they would take a huge loss on the dollars they bought up till now. So they're trying to preserve the value of the dollars that they do own while shifting away from dollars with the ultimate goal of not using dollars in the distant future. And so that's kind of a balancing act for them. I'm
sorry.
Oh, no, you go ahead, Roy.
Well, is it going to get to a point to where China, Russia, and India have enough gold to where they say, we no longer care. We're going to dump the remaining balance of our treasuries and our dollars onto the system, and good luck.
Well, that's one scenario. And that would probably be the ideal scenario for these guys, but it's like anything else. You can't predict how it's going to go. All you can do is make the best choice today and kind of hope that it gives you a few years in which to continue to build up credits in one way or another. It's like saving against a potential problem in the future. If you get to save for 10 years, then when the problem happens, you can handle it. But if it blows up on you in 3 years, maybe you won't have saved enough money and it's a problem. And that's what these guys are looking at. They don't know when the resolution of this will happen, but they know that each year that they're able to use their dollars to buy a bunch of gold, they get closer and closer to being able to handle it when it happens.
Okay. And we still have no idea how much gold China has. I mean,
No.
but we do, Russia is kind enough to at least provide us with a number. How accurate that number is, I don't know. I,
Yeah,
I
yeah. I mean,
question it, but
it's a fair bit, and it's growing, and that's really the important
steadily.
thing. Yeah,
Yes.
that they're continuing to add to their gold and to an extent silver stockpiles is pretty much agreed by everyone. That's what's happening, and the actual numbers are less important than the trend. As long as they're continuing to use dollars to buy gold, then things shift in their favor from their point of view.
Oh, okay, and that makes sense. Now,
Yeah.
okay, I understand that. That absolutely makes sense. So I'm going to keep the trash over here that I can exchange for something of value as long as I can.
Yeah. Oh,
Okay.
it's like anything else where it's an investment program. Say you like Google, you think it's going to go way up, but you're not going to buy it all at once, right? You buy a little bit every month of Google stock, and you hope you get a few years in which to continue to buy it before it shoots up. And if it shoots up in the short run, you still make some money, but you didn't do as well as if you'd had a few years to put this program into practice. And that's kind of what these guys are doing now. They're accumulating gold, knowing that at some point the world is such that old kinds of money that governments can't create in unlimited quantities like gold will become valuable again because we're destroying our fiat currencies. So relatively speaking, gold's going to get valuable, and they don't know when it's going to be, but they know that the dollar will go down versus gold at some point in the future, and so they're kind of dollar cost averaging. They're buying a certain amount of gold every month,
Yeah.
and buying a little bit more when it goes down, a little bit less when it goes up, and figuring that if they get to do it for a while, it'll work out for them.
Well, do you think that it's so? I would have to presume that you believe that the individuals should have gold in their possession.
Yeah, yeah. I think we should all be dollar cost averaging out of fiat currencies and into real assets.
Okay.
And gold is one of the things that people should be accumulating, but not all at once, because you
Yeah.
never know what's going to happen in the short run. Gold is $1,200 an ounce right now. It could go to $700 an ounce in the short run. It's had wild moves in the past, and it's completely possible. But if you're buying a little bit each month, that's not a bad thing, because then you get to buy more with the amount of money that you were going to put in this month. And over time, it works out for you. If it ends up going up 5 years from now, then everything you bought at whatever price in the next 5 years will be a capital gain for you. You'll be up. And that's basically what you want. You want to gradually shift your finances away from these fiat currencies that the governments of the world are actively trying to make less valuable, and into things that will probably hold their value over time. Farmland is another example of that. And over time, energy assets have generally held their value. So,
Do you like silver?
Yeah. Silver's a same thing as gold. It's a
Same thing.
historically stable form of money that over the last couple of thousand years has stayed valuable. And so there's no reason to think that through the next set of financial crises, it will not hold its value. But again, it's volatile. It can go up and down from here. You just can't know in the short run what it's going to do. But over time, it'll probably be one of the things that holds up reasonably well when financial assets are really getting creamed.
Well, and on that note, I will let you get back to your afternoon. I've kept you way
All right.
longer.
Yeah,
I've kept you way longer than I said
yeah.
that I would.
It was a fun conversation, Rory. I'm
It's been
looking forward to the
great.
next one.
Well, we will do it again, and like I said, I'll set up an appointment with Sean so that we can get you over on SUT Report. And John, I certainly appreciate it. And please, everyone, visit John Rubino at dollarcollapse.com, and you can find his work also at thedailycoin.org, as I repost everything that he publishes because I love your work. So
Thanks, Rory.
All right, John. Well, you have a good afternoon. And once again, I appreciate all your time.
Sure. Take care. Talk
Thank
to you
you.
soon.
All right. Bye bye.